Let's ask Dan Greenhaus of Solus Alternative Asset Management. He is here with me at Post 9. Welcome to our new show. It's good to have you. It really has been a tug of war, right? And, bond yields kind of taking a back seat for a little bit to stocks until now they pulled stocks into the sandbox a little bit, haven't they?
I mean, you've seen a real repricing for Fed funds expectations, which has obviously gotten a lot of attention, but less so you've seen a real repricing on the inflation side of things. Inflation pricing at the 1 year and the 5 year tenors have gone straight up over the last couple of weeks, and I think it complicates the Fed's position here and investors' position in the sense that if you think they were almost done, some other parts of the market, not the equity or the credit markets, are telling you maybe they have more to do.
So are we just in the stages now of the stock market catching up to where the bond market was leading things?
Probably. I mean, last time we were on, listen, I think there's a lot of conversation that the market was ignoring what was going on in the bond market. And my point last time was, let's not dismiss that there are positives going on. The China reopening, the lack of a recession in Europe were two things to which I pointed. Those are still true today. But at the end of the day, the speed of the rate adjustment was so much that the equity market probably couldn't ignore it for much longer.
Fed minutes today, the market didn't really react all too much. The bottom line was you basically had everybody think 25 was right. Now that maybe it's settling in, the Dow's down 143 points as we watch it now. China reopening and Europe should help the U.S., elevated chance of recession in 23. Nothing shocking.
No, but listen, I think there's an important conversation that we're not having here. We're lost in the 25 versus 50 right now, but there's a bigger conversation about whether everybody, myself included, not everybody, most people are misunderstanding the economic environment and how the Fed is supposed to respond to it, meaning you've hiked, let's call it 500 basis points, and the economy is doing a lot better than a lot of us thought. And so the question becomes, is that equilibrium rate, the rate at which you start to choke off activity, higher than we thought? And if it is, then the Fed needs to go even higher still. So we're talking about what everyone calls the terminal Fed funds rate at 5 or 5 1/4. That number might be 5.50, 5.75, or even 6.
Well, I mean, even though, let's say Bullard, for example, somebody who's been, I think, more hawkish than most, I think that's fair to say, was on our network today. 5.375. Is where he talked about taking it. That's not, out of the crazy realm of where the market has moved to. It implies 3 more 25 basis point hikes.
The street is now coalescing around 550. The only bank that I know of off the top of my head is Matt Lazzetti over at Deutsche Bank. They're at 575 for the final hike. But everybody else is moving to 550 if they weren't already there.
Yeah, bear with us just 1 second because we do have some news that's breaking at this very moment. And you want to comment, Dan Greenhaus, just on the idea here of a pickup in activism, how this dislocated market and some of the uncertainty we've seen, some of the big declines in stocks have certainly led to more activity, it feels like.
Yeah, no, I think it's fair to say that the type of environment in which we find ourselves lends itself very well to an activist campaign. I will say, knowing almost nothing since I was traveling over here and didn't read the letter about Third Point's campaign specifically, in the world in which we live at Solus, we deal with management incentive plans all the time. And I can say that I am certainly an ally of everybody and anybody who finds excessive executive compensation in the right circumstances egregious and worth fighting for. That's certainly an idea with which I would agree.